Rates continue to push lower the more it becomes clear the Federal Reserve is going to get out of their way. Treasury yields have slid to their lowest in the last couple months after another one of these short-run inflation freakouts predictably runs its course. But why do rates want to go lower? That is the $10 trillion question. The mainstream answer is because of the Fed cutting rates, duh. The market is just front-running the Fed, but that's just another way of giving the FOMC too much credit when really saying the Fed is going to follow the markets. Consider some simple yet utterly profound bond market math. The math no one seems to want to acknowledge. In 2021, the benchmark 10-year Treasury was around 1.2% to 1.5%. That was even when the CPI was going ballistic. Bond rates remained ultra low. Why? Again, the mainstream answer is the Fed, and you might be sensing a theme here. Not only was Jay Powell holding short-term rates at zero, the central bank was also gobbling up hundreds of billions in bonds, trillions of them, monster QE. Since that time, however, the Fed stopped buying bonds, and it pushed its short-term rate benchmarks aggressively higher by 5.25 percentage points. Not only that, the FOMC has allowed $1.28 trillion in just treasuries to roll off its balance sheet. Now that wasn't direct selling them, just passive QT, but that left a whole crap ton more bonds for the market to buy. And as we know only too well, the federal government's debt absolutely exploded higher during this same period. Treasury added almost $5 trillion in debt held by the public. And yet, despite all of those things, the Fed rate hikes, the Fed no longer buying bonds and instead rolling off more than $1 trillion from its balance sheet, the federal government issuing almost $5 trillion, despite all of those things, how in the hell is the 10-year Treasury yield only about 3 percentage points higher than it was in 2021? And it still wants to go even lower. How can all of that be? Interest rates express a fundamental value, the combination of growth and inflation expectations. But economists can't accept this reality because it destroys their entire econometric-centered worldview. So they try to cast rates in the market as a function of something they might understand and, most importantly, get you to believe they control. Alan Greenspan said as much as Federal Reserve Chairman testifying before Congress in February of 2005. His famous conundrum wasn't really a speech, but his famous conundrum passage. What he was basically saying is, we believe interest rates should be doing this, and they're not doing this. Sounds familiar, right? He told Congress the simple mathematics of the yield curve governs the relationship between short and long-term interest rates. 10-year yields, for example, can be thought of as an average of 10 consecutive one-year forward rates. A rise in the first-year forward rate, which correlates closely with the federal funds rate, would increase the yield on the 10-year U.S. Treasury notes even if the more distant forward rates remained unchanged. And there's some truth to what he's saying, and I'll get to that in just a minute. But basically, if the Federal Reserve raises short-term interest rates by, say, a percentage point, then the first year forward, which would be about the one-year Treasury, think about it as a one-year Treasury maturity, that would have to go up by 1 percentage point too, because the Fed hikes short-term benchmarks at the front. Therefore, that feeds into the next forward, and then the next forward, and then all the forwards on down the line. So the Fed hikes interest rates by 1 percentage point. Every spot on the yield curve must go up by 1 percentage point too. That's what Greenspan was telling Congress. And that's what he was saying how interest rates work. The Fed sets the front and all of the rest fills in nice and neatly behind. And he wasn't alone. Many people thought the same thing. Quite famously, I think in the month after Greenspan's testimony in 2005, Bill Gross, the bond king himself, he didn't use the word conundrum, but he came out and said, you know what, I'm a little surprised by the bond market here too. It doesn't seem to make sense. The Fed's hiking rates, so why aren't all the rest of the rates on the yield curve falling in line? And the answer is an assumption that economists make, and Bill Gross is an economist, by the way, assumptions that economists make about how the markets actually work. We'll go back to Greenspan a couple years earlier in June of 2003 when he said, it's really quite important to make a judgment as to whether, in fact, yield spreads off riskless instruments, which is what we have essentially been talking about, are independent of the level of riskless rates themselves. The answer, I'm certain, is that they are not independent. In other words, just like he told Congress in 2005, the Fed sets the front end of the curve, everything else moves along in line, and then the spreads on top of these risk-free rates also behave dependently, not independently. That way, the Federal Reserve can at least claim to control all of the interest rates across the entire marketplace. Fed raises the short-term rate and everything else falls in line. But you can already see a whole bunch of problems. Now, as I said before, there's a little bit of truth to this, because if you think about this mechanically, you do, as an investor in the Treasury market, have to pay close attention to the interest rates that are offered by the central bank. Whether they're set by economic conditions or not doesn't matter. The Federal Reserve says, I'm going to pay you 5% in the RRP these days. Back then, they just targeted the federal funds rate, which meant you could get a certain rate in federal funds. But I'm going to give you a short-term interest rate as an alternative. So if I get 5% in an RRP, even though I'm negative on the economy and pretty much anything else, I still have to consider I could get 5% from the Fed. Do I want to own a 52-week Treasury bill that yields a lot less? Well, it's going to take a lot of pessimism to get me to want to own that 52-week bill at a lot less than what the Fed is offering. Because what you're thinking is that over the 52 weeks I own the bill, what are the chances the Fed's going to be able to maintain that 5% level? So if the bond market is thinking, well, there's a good chance that the Fed isn't going to be able to maintain its 5% interest rate, then I don't really have to pay attention to the Fed. I can focus more on fundamentals. And the further down the curve you go, you start out by thinking about where is the short-term interest rate today? Where might the short-term interest rate be tomorrow? Where is it most likely to be heading? And then think about the fundamentals in the economy based on that anchor point. So we're anchoring to short-term interest rates, but the further down the curve you go, the more independent those market interest rates end up becoming. The fundamental properties of growth and inflation, as Irving Fisher pointed out a very long time ago, and he wasn't the only one to do so. But even if market rates are somewhat independent, as I said, it all falls completely apart. Now, market rates aren't entirely dependent, which is again why they start from the short-term part of the curve. But low rates signal expectations for low growth and inflation. You almost have to do a little bit of math, the opposite of what Greenspan was doing. Look at where the interest rate is in comparison to the short-term rate, which gets us, in this particular period of time, inversion. Inversion in the curve is the market continuing to say expectations for lower rates in the future for fundamental reasons. It really is that simple, which is why the mainstream argument for rates being about Fed buying and government supply just doesn't match up with reality. They always tell you to ignore market interest rates because the Fed is buying bonds, right? QE means that rates are going lower because the Fed wants them lower. But as I said, over the last couple of years, we've tested this theory. It doesn't hold up to reality. The Fed was buying bonds, rates were low. The Fed wasn't buying bonds and allowing a lot of them to roll off, rates continue to be low, especially in comparison to where the short-term benchmark rate is. Fed bond buying doesn't matter. Treasury supply doesn't matter either, because the Treasury supplied a ton of bonds in 2020 and 2021, and it supplied a ton more bonds in 2023 in particular. Didn't make a difference. Interest rates are fundamental, and we are proving that over and over again, proving that and establishing that thoroughly in our experience of the last couple of years. Rates are low compared to where short-term rates are, the Fed's benchmarks, and they continue to want to go lower every time it looks like the Fed is going to get out of the way and allow rates to go where the real fundamental values are. So how can there be low growth and inflation expectations given the consumer prices the last few years and how everyone says the economy is so hot and booming, and it started right in 2021 too? Well, we had high nominal but low real growth. With low real growth, that can't support the continued nominal growth because that means we're spending more to get less. We're getting paid a bit more, but it buys less. Businesses who have pocketed those price changes happen to be the most unproductive. So those changes simply accrue to them without being circulated in the most efficient and sustainable fashion. It was all artificial, a price illusion. It was not a sustainable recovery. It wasn't red hot. It was a whole bunch of distortions and imbalances that have to be corrected. And they are being corrected, and the bond market is saying they are going to still be corrected. Government has been constantly injecting funds just to keep it all from falling apart, too. But it isn't nearly enough. That's why you see the real GDP, for example, or real GDI, well off its 2010s trend. Because in real terms, we keep falling further and further behind. The government is doing its best to prop it up, lest it revert to its fundamental basis too quickly and in too disorderly a fashion. So when we think about the 10 forwards under Greenspan's theory, what that says is over the 10 years starting in, say, 2021 or even 2020, the first part of that period will have looked all inflation-y, as it has to most people, but the back end won't. Because we can't keep it up, it's all just an illusion of nominal numbers. There's going to be a transition from one period to the other, and it's likely to involve a lot that is not fun. Recession, maybe even deflation. And the more that looks likely, this transition, the faster rates will want to go lower, because it means the quicker we get to the latter part of that period, the part that looks like the 2010s in the real economy. And we also have to consider all of the other imbalances that will have to be sorted out along the way. We've got labor imbalances from the supply shock. We've got this favoring of the most unproductive sectors at the expense of productive sectors. And finally, the financial bubbles, commercial real estate, and some other places, even residential real estate to a certain extent. There's a whole lot of imbalances that need to be cleaned up before we can even consider what the long-run economy might look like on the other side of everything. And the bond market is simply pricing the fundamentals, the probabilities, that when we do get to the cleanup process, it's not going to look like a red hot economy or economy that has recovered. There's going to be a whole lot that doesn't look good. Low growth and inflation expectations. So what we're looking for is evidence this transition either isn't happening, that we are in a legitimately red hot booming economy, which the bond market already says is not likely, or that the transition is happening. And all the evidence, especially what we're seeing lately, continues to show that it is. And we have to include other markets and prices in that too. We've got the dollar exchange value. How about energy prices? Oil prices that continue to fall here, despite all of the imbalances in oil and gasoline, supply factors and whatnot that I went over in yesterday's video. Markets are going down because the transition continues to show up. It looks a lot like recession. The one that's left out of all of that is, of course, the stock market. The booming stock market, which many people are fed to believe is equivalent to the economy. Red hot stock market, red hot economy, but that's not what happens at all. I mean, you want to talk about low growth and inflation expectations in the market and why we transition from one period to the other. Listen to this from earlier today, published in Bloomberg. Almost 2/3 of Americans considered middle class said they are facing economic hardship and don't anticipate a change for the rest of their lives. And that's according to a poll commissioned by the National True Cost of Living Coalition. In the large poll of 2,500 adults, 65% of people who earn more than 200% of the federal poverty level, and that's at least $60,000 for a family of four, often considered middle class, 65% said they are struggling financially. It's 2 out of 3. The economy is booming, and yet many Americans are still grasping for the air financially, said Jennifer Jones Austin, Chief Executive Officer of the Federation of Protestant Welfare Agencies, an anti-poverty advocacy organization, as part of the team that commissioned the poll. And there it is. Even she says the economy is booming, but it sure as hell doesn't look like it's booming. 2/3 of middle-class Americans, according to this poll, feel that they're facing enormous hardships and are being left behind. You cannot have that many people being left behind and call the economy booming, because the economy only looks like it's booming from a narrow slice of economic statistics, those that the mainstream continues to focus exclusively on. And even those are starting to look less boomy, less inflation-y, and more bond market-y. By all those traditional accounts, it has looked pretty good. Stock market's booming, so everything must be fine. But more and more we continue to see, the world ends up looking and sounding and feeling like what bonds are pricing. Low growth and inflation prospects that are not so much future prospects as much as more and more current reality. We start to see how people repeat the fiction that the economy is booming, even though they also cite all of these statistics that show it absolutely cannot be. We got a reminder of that today too with the JOLTS report for the month of April. Another low level of hiring, and even the jobs opening number tumbled all the way down to almost 8 million, which is still elevated, but that's a faulty number that nobody should pay attention to anyway. But you know who does pay attention to JOLTS job openings? That's Jay Powell. So it's another one of these statistics that the Federal Reserve looks at that is more likely than not to get the Fed to think, I'm going to get out of the way in terms of short-term interest rates. Not higher for longer. Maybe I'll start thinking about rate cuts, and so market rates have a clearer path to go lower where they want to go because of the fundamentals of this economy. And the fundamentals of this economy are not what everybody says about this booming system. Of course, if you look at interest rates on a fundamental basis, it doesn't really cast the Federal Reserve or the federal government, for that matter, in the most positive light. Remember the 2010s wasteland of an economy, disinflation puzzle? Well, it was never a puzzle. It was never a conundrum. The bond market had it the entire time. There was low levels of inflation or consumer price growth because the economy never recovered from 2008. Now, while the shock of 2020 and 2021 was a very different kind than in 2008, it was still a shock. It was still a distortion. It was still introducing tremendous imbalances that will have to be corrected. And by all accounts, including GDP, GDI, and even payrolls to an extent, we are transitioning. We are going through that correction. The correction that the bond market has been telling us all along. Because at the end of the day, when you do the simple bond market math, and not the math that Alan Greenspan was trying to do back in 2005 or 2003, simple bond market math, how the hell is the 10-year Treasury only 3 percentage points higher now than it was in 2021, given everything that has been thrown at it? Again, rate hikes by the Fed, aggressive rate hikes by the Fed, QT, enormous issuance of Treasury bonds, and yet the 10-year Treasury, the 5-year Treasury, the 2-year Treasury, they are all hanging in there and continuing to move lower where it seems the Fed is going to get out of the way. No one in an official capacity is ever going to stand up there and admit that they impoverished the world over the last couple of years. They're never going to say it. But the bond market can sense it, consumers can feel it, and some of the data, and quite a lot more of the data, starts to look like it. What consumers are picking up on that maybe living standards, while still expanding, are not expanding at the same rate they did before, and the consequences to that are more than just their feelings. That's the video I've got linked below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.